Welcome to the Daily Update, where we'll look at the action in the markets for Friday, March 11th, and then we'll see how things look for Monday, March 14th. And for those of you that are interested, I do prepare a weekly video each week. I'm doing the daily video first, and then after I finish with that, I will do the weekly video. So let's see how things look. It was a negative day. We actually had a gap higher at the start, and it looked like things could be somewhat positive. Well, as the day went on, buyers lost enthusiasm, sellers picked up enthusiasm, and we ended up closing pretty much at the low for the session. There's just so much going on right now that people are having to digest, either financially, economically, intellectually, politically, and it's on so many different levels that when people have this overwhelmed feeling, we just kind of shut down, or sometimes the way I like to say it is fall back and regroup until things become a little bit more clear. And that's kind of what's happening right now in the markets. So what can we say about what happened on Friday? We did have a gap higher at the open. The futures look pretty strong. And the economic report that came out that I'll address later, that didn't come out until the market had been open for a half hour. But right after that gap higher, we saw selling, and that ended up taking prices negative. And then throughout the day, we just saw sustained selling. We closed pretty much at the low, and we ended up being down 1.3% for the session. But take heart, because on a Friday before a weekend, we saw below average volume. So that just means that there's not an awful lot of conviction. That's the positive way to look at it. A negative way to look at it is people are becoming more complacent, and we're not seeing any kind of a blowout or critical mass or crash type situation that usually ends difficult times. So we kind of have to look at both of those scenarios at the same time, that we're seeing more sustained fear and weakness, but yet we're not necessarily seeing it real intensely. The technicals continue to be negative. Earnings are still coming out. Inflation, that was the big story this week, and I'll go back and briefly review that again, and I'll address that in the weekly video. Interest rates are also all over the place and really causing some issues right now, because the Fed has kind of backed themselves into a corner where on one hand, they're still trying to stimulate the economy, but yet the economy is going fast enough and inflation is high enough so that they need to try to slow down things. And they're kind of doing both at the same time. And then, of course, we have the geopolitical concerns. And I took the Iranian talks that were happening in Vienna off because I just saw something a bit ago that said that that stopped now. They have decided not to continue talking for the time being. So some comments that we can make: we're still in correction territory, and with the decline on Friday, we're a little bit deeper into correction territory. Technicals are negative. We're showing some extreme fear, and we've been showing that now for a few days. That could, excuse me, that could potentially be positive, because it just shows a real extreme pessimism right now, which sometimes can be a good time to buy. Prices remain in the range, and on the last slide, I actually changed that to an intermediate term range now. We're still dealing with Russia, Ukraine. That continues to go on, although some of the news is being replaced by more domestic issues inside the US. But still, people are focused on what's happening there. There's some scary things coming out about biological labs that were set up. We're not even really sure if that's true or not. Apparently Putin had come out on Friday and said, yeah, we think they might calm down a little bit. Well, we can't even believe our own government. Do you think we can believe what Putin says? I don't think so. We do have the oil issues, which you're probably feeling every day, as well as inflation. And then I say, is a possible base forming? with a stress on the question mark at this point. But when we take all these things together that I'm going to address, this sometimes can be, we've tipped so far to the negative side, especially with the way people are feeling, we might be getting either at or near a point where prices could see kind of a rebound. Now, we're not seeing any of that in our technical picture. When we measure the direction that things are going, they're negative, they're going down. But when you look at it more on an emotional level, this sometimes can be where things might start to get better. Another thing that came out on Friday was the consumer sentiment, and it's probably no surprise, but it's declining. That's the preliminary report, and then next Friday will be the final report, just to show that people are just not very happy with what's going on right now. They're not feeling good about things. The market is still overvalued, and the trend is negative and getting stronger with our ADX. The bias, since we had a down day, that's negative, as well as the momentum 2, 3, 4 days out. So overall, it's a pretty negative picture right now, but there are some positive things to be aware of. So we're going to talk about today's session first by looking at sentiment, where we're extreme negative. That is potentially positive number one, where you're seeing extreme fear. But we've been here for a few days now, and looking at the chart, we can, if we have an up day, it comes up a little bit. If we have a down day, it goes down a little bit. But this is pretty extreme. And if you're looking back in history, this is where, in very recent history, by the way, this is where moves higher have launched quite often. Now, another thing that could potentially be positive is, yeah, the VIX went up on Friday, but not very much on a closing basis. We had a pretty strong down day, but the VIX didn't really go down, and we're seeing it go down also on the daily chart. Now, it closed near the high for the day, and this can always change with an increase in participation in the market, but that could be somewhat negative. It's like people are tired of being fearful. It's like, oh yeah, here we go again. And they're getting a little bit complacent in their fear, if that's even possible. The VIX of the VIX also showed a decline, even though we closed near the top, and it has been declining overall, and we have kind of a flat line right here on a closing basis. The Ulcer Index is also not really going up all that much. Yeah, it is going up, but it's not spiking at this point. So that's also showing a little bit of complacency with fear. And then here's just the longer term perspective of that same chart. This is the report that came out, and this is part of the contradiction that we're seeing. Typically, when you see consumer sentiment, which is the blue line, going higher and higher, people are feeling better. Yeah, they don't just automatically feel better. It's up and down, but the overall trend goes up. Well, we've been seeing the market going up overall as well. When we see consumer sentiment coming down, the market tends to go down, and interest rates also tend to go down. As I stated the last time with this chart, they're going in opposite directions. We're seeing interest rates going up and sentiment going down. And then down below is just the difference between the two. And if we look back in history, it doesn't really show up around the 2000 area, but in 2008 into 2009, we saw a spike. Well, we were in bad times at that time, but we were starting to come out of that when this started to show a series of lower highs, at least according to this ratio. Well, we're going higher now too. So this is starting to get extreme, and something's gonna probably have to give here. Either they're gonna try to do things to make people feel better, so sentiment goes up. Good luck with that. Or they're going to have to get to a point where interest rates actually start going down. Yeah, good luck with that in a high inflationary environment. And that's part of the real contradiction that we're seeing right now. The sectors, we had a down day. Discretionary, which it's been getting hammered, but it really got hammered after having a couple of good days. It led the way lower, and every one of the sectors was negative on Friday. Communication, tech, the usual suspects, staples, which that's again more of a value play, but across the board, we saw all of the sectors declined. So it was pretty broad based. This is going back to the all-time high, where energy has been the best performing sector, with discretionaries being the worst performing sector. As far as inflation, the BDI did tick up, and it's starting to show some of the inflation that we've been talking about. Then the CRB, it was up 1.5% on Friday, and it's just been going straight up too. And that can be used as a good inflation gauge as well, since these are the products that we get. I just want to show this one more time, where the CPI, our inflation rate, came out on Thursday. The orange, greenish, yellow, not green, yellow, red, whatever you want to call that. That's the official number that came out at about 7.9%. If we go back to how it was calculated in 1990, we would be up around 11, 12%. And then if we go back to how it was calculated in 1980, we would be at well over 15%, 16, maybe even up to 17%. So that, and this blue line is more what you're probably feeling day to day as you go to the grocery store and as you fill your car and as you watch the news and as you figure out what in the world is going on here. Then I'm also going to start bringing up more charts that will also show inflation, where we saw this past week a real spike up in wheat prices. Yeah, Ukraine produces a lot of wheat. And so when they're under attack, that's going to limit the supply and really push up demand. And so prices have been going up. Well, we've come off of that a little bit, but we want to keep an eye on this, because when was the last time this happened? Right? During the financial meltdown. Same thing with heating oil. It's also come off of its highs, but when did it act bad before? In the financial meltdown. Nickel, which made some news this week, it was pretty much flat according to this chart. It is also spiking up very dramatically. When did it happen before? Late 2007, right before the financial meltdown. Gas, also going parabolic these days, even though it has dropped back. But we look back in history, when did it get really high before? 2008. And there's been some other times along the way too. But these are just things we want to keep an eye on. Now, when I say that we're possibly forming a base, that might be a blow off top if it ends up happening. If we have more run to the upside, that might be last call at that point for quite a while. If these things that we're seeing are still in play, and if they do impact stock prices, and with all the geopolitical events that are happening, maybe some good news breaks out and the market has a few good days, we're able to suck enough money back into the market to make it go higher. And then possibly after that is when things could turn pretty nasty for a while. That's kind of the scenario that I'm working with right now. That could change at any time. But I've been working on that scenario for some time now, and I kind of thought it would already play out, but it hasn't. But we're still seeing signs of that. So look for one more move to the upside. Everybody seems to start feeling good about things again. We get a blow off top, and then that's when the really big downturn starts to happen. I hope I'm wrong. I really hope I'm wrong, but I've studied this stuff long enough and I've looked at it. We're comparing it with what has happened before, and that could be what ends up playing out, or it could be something completely different. The idea behind having these scenarios is not to write them in stone. And that's one of the biggest reasons why people fail in the markets. They take their opinions, project them onto the market, and then set up their positions that way. Well, the market doesn't think that same way that you may or may not be thinking, and does the opposite, and then you end up losing money. where we have to be more open to a lot of different scenarios at the same time, whether you think they're conspiracy theories or they're kooky based or that they come from crazy land. We still need to at least consider them, because one of the things that I've learned in over about almost 30 years of studying the markets is what gets you the most is what you don't expect. And so what we need to do is plan for everything at the same time so that we can adjust and adapt as we see things unfold. Okay, then looking at the aluminum index, which is also been going higher, even though we're well off the highs right now. As far as the Fed watch, they're going to be meeting this coming week, and they're probably going to raise interest rates. In fact, there's almost a 95% chance that that is what will happen. But there's still about 5% of folks out there that think that we might not do anything. Then here's just the longer term historical chart of how that has changed. Then another thing that was updated and came out and finally seemed to update a little bit more, so I'm including it again, is this is quantitative easing. This is the Fed balance sheet. This means that they're out buying bonds and adding it to their assets. Well, they're raising interest rates on one hand, which is a stricter monetary policy, but yet they're in the market buying bonds to help keep interest rates low at the same time. So this is part of the corner that the Fed has backed themselves into, and nobody really seems to have an answer at this point. But it's like they're doing the opposite things. Will they cancel each other out, or does what has to give at some point so that at least the Fed is going in one general direction? Technical alerts, not as many on Friday. The NASDAQ was able to get above 13.2, but then spent the rest of the day going down 13.1, 13, 12, 9, blah, 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 blah. Gold, which had been doing quite well, actually dropped below 2,000. And communications, which has been getting hammered lately, it's showing a BPI cross above 30. That means an official oversold signal has now been generated. And so that may provide some support for prices to go higher in the communications sector. Looking intraday, here is the gap higher that we saw right at about S1. Well, that ended up being the high for the day. We dropped down and we bounced around unchanged for a little bit. And then after the open got itself situated, this is when we took things lower. We dropped below the pivot. We tried to find some support, bounce up a little bit. That didn't last very long. Got us back up to the unchanged because now this is acting as resistance. Came back down, danced around, and then this was probably the most negative part of the day from a technical perspective, because this is the late day selling that we saw, and then we pretty much closed at the low for the session. Then looking at the bar chart, we had been kind of flirting right around this more intermediate term support. Well, we've now dropped below that. And we do have some support below us if prices continue to fall, but it's going to do a lot more technical damage. So that's why we're bouncing here, folks. You've got a lot of people that just don't have much of a conviction. You can have all the opinions you want, and you can come up with your analysis. That's what I do. But we ultimately have to say, what is the market doing? The market is always right. It may not always be correct, meaning we thought everything pointed to it going up and it's going down, but we have to follow price. And that's the ultimate say in what's going on. You might have a 10-volume library of reasons why prices should go in a certain direction, but then they ultimately don't. And that's what makes this, I find it thrilling and interesting and very challenging to try to overcome all these different things. But this is what leads to a lot of frustration and why it leads to high turnover with people that think it's really easy to do this, easy to get in, easy to get out. Well, then they get themselves backed into a corner and they end up losing a lot of money and just saying, I just give up on this whole thing altogether. We are now down 12.35% since the all-time high. So we are into correction territory. We did see a decline in growth and an advance in value on Friday. And then to compare the two indexes, this is showing the decline in growth, where the next chart is showing the advance in value. And then to compare the NASDAQ 100 to the S&P 500, the NASDAQ 100 did underperform. Okay, so let's look over our trend and see what that is telling us right now. Here is the ADX, and this is what I like to use for determining whether we're in a trend or not in a trend. Okay, so, and you'll have to excuse me from, there was a little bit of a time gap in between when I was recording before to right now, but we are showing a strengthening trend, and this dark line is above the moving average that I have plotted here. And since the red line is on top, that tells us that the trend is down. But on a little more positive note, we're seeing a decline in selling pressure and just a teeny tiny little bit of an advance on buying power. So it's negative. You can't dispute that. And it's giving us a pretty high reading. It's well above 20. When we drop below 20, that means we're more in a non-trending environment. But because the moves are so big right now, it's still picking up that we are in a trend, and that trend is negative. Another thing that's just about ready to go off the table for right now is this thing called the mass index, where when it went above 27 and then back below 26.5, that's supposed to be a signal. Well, we really haven't done very much. We've went down, we've gone back up, we've gone a little bit down, and maybe that's the signal that it wanted to generate, but usually it produces a stronger type of signal, and we're just kind of waiting to see if that's going to be up or down. The Arun is showing a little bit of improvement, where the red line, this is selling. When that's pegged near the top, that means that sellers are in complete control. Well, we've seen that start to decline this past week. The green line, which is lower, and when it's pegged near the bottom, that means buyers are pretty scarce, if to non-existent. That has been declining this past week, but on Friday, we saw a little bit of an advance in buying power. So when you compare the two with each other, we're having a bit of a turn up overall. It's not positive, but it is improving. Then this is the one I mentioned in Friday's video. This is called the Pring Bottom Fisher, and this can be good. It's not perfect, but it can be good in suggesting when we are at a bottom in the market. Now, we just had a false signal right before this. Early to mid part of February, these lines crossed, but yet nothing. We tried to break out a little bit, but it didn't really lead to anything. And so that signal went away. It's been declining. And right now, after Friday's session, we are seeing another potential cross. And that's part of this potential bottom formation that might be forming. This is just another signal. Doesn't mean that's what will happen, because this indicator is not perfect. But we're seeing a lot of things coming together at the same time that usually happen before we get ready to go higher. Will this time be different? We'll have to see, but just be aware of these different things with sentiment and with some of our indicators. No change in the decision point scoreboard. As far as breadth, we, with the down day, saw a decrease based on price and volume, and we're seeing trailing off with the price, and we're still seeing more of a strengthening decline based on volume. The advanced decline ratio, it's kind of been bouncing around, but it is below zero, declining, and is negative. Then this is the one positive thing that I've been looking for, but we're starting to lose that now. That's the new highs against the new lows. We saw some new highs generated on Friday, but the overall uptrend that we had been seeing is starting to go away. And our moving average, that's a little bit longer, that's based on 10 periods, it is starting to go flat to even a little bit down now. Accumulation, distribution. Accumulation is when we're seeing buying. Distribution is when we're seeing selling. When we're above this red line, that means people are buying. When we're dropping below it, that means people are selling. Well, we're dropping below that, but we've been bouncing back and forth for quite a while now. So this hasn't been all that helpful. And you'll also notice on this chart, we're getting really close to another death cross with the S&P 500. The 50 period moving average is coming down and is in danger of crossing the 200. Now, this is a simple moving average. If you use exponential moving averages, it probably has already happened. But simple moving averages are a little bit slower than exponential moving averages. Looking at the short term, we're far away from both of the different 20 period moving averages that I follow. Our moving average study shows a decline based on the 20, 50, and 200 day moving average. And then this, I call it the spaghetti chart, where we're well below any of the moving averages, and the shorter term ones are really starting to pick up steam to the downside. The MACD, which was trying to go positive a couple days ago, well, it's now more decidedly negative. And then our short-term oscillator is seeing a decline based on price and volume. So things aren't negative. The thing that I'm looking at is a possible formation we're not seeing confirmed in any way right now based on price. This is just the sentiment and overall feeling right now. The McClellan oscillator is also negative. And the Stoke RSI, it had been positive after Thursday's move, but then dropped back down and is just a little bit positive right now. If it drops below this dotted line, that's more negative. And the Williams percent R, which didn't really get all that positive, is also showing more of a short-term decline. The force index also declined on Friday. That's a shorter term indicator. Looking at the intermediate term with our 50 period moving averages, they are a long way away from where we're at right now. The PMO, this is kind of interesting. We're seeing the PMO decline, and that's decidedly negative, but based on price and volume, these measurements are showing a little bit of improvement and are trying to actually cross positive. So this is giving us a mixed signal overall, but a little bit of hope at the same time. Our other PMO study shows a decline in those PMOs in the S&P that are rising. We're flat with those that are giving buy signals, and we're declining with those that are even above zero. The BPI, bullish percent index, it actually bounced up a little bit on Friday. There's a little bit of hope there. And this just gives you a longer term perspective, but it's a little harder to see the detail of this chart. Moving average rainbow, we're well below the rainbow, and the top part is starting to fold over. Stochastics, short term negative, intermediate term positive, long term negative. Summation index based on price is declining, based on volume has now calculating that we're declining as well. And then the only one of our momentum oscillators that's positive is this very top one. That's the slope oscillator. And it tends to be more short term in its nature, but the rest of these oscillators are still negative. Vortex, this is also something a little bit positive. We're the red line's on top, so we're negative, but we're seeing a decline in selling and a little bit of an advance on buying. When we get a signal from this is when these two lines cross. RSI also showing a decline after Friday and is below 50. And then this is the rate of change looking back 50 periods. It shows that we are extreme negative right now. That's another more longer term scenario for saying, is there a possible base forming? That's not a prediction that I'm making. I'm just saying a whole lot of things coming together. Also, the Sean trend meter has gone back into extreme negative territory, and it spent the last few years not even getting close to this level. So this if it starts to turn back up, could be positive. Our different trading systems, our elder system is now negative, that's shorter term, where our SAR continues to be positive with the dots underneath. Even with this pretty big decline here, it's still picking up an overall uptrend. Our different charts, the Heiken Ashi is more of a doji where we're right in the middle of things. Kagi chart continues to be negative with the red line. Renko chart redrew a little bit, but it's still negative overall. And our 3-line break is also negative. Equi volume, it's also pretty much negative, but we're seeing the ease of movement go up a little bit based on just one period. So it's very, very short. But when we calculate this over 14 periods, we're seeing a bit of an advance. It's just trying to measure the path of least resistance. Well, this indicator is suggesting that we're seeing some improvement. No change on the point and figure chart. No new signals, no new X's or zeros were drawn after Friday. The Fibonacci, we're bouncing from 61.8 into the 50% range. And we're kind of right in the middle of that right now. Long-term chart, we are below the longer-term moving averages on the arithmetic scale and the logarithmic scale. KST, I'm sorry, the special K, which is a longer-term oscillator, continues to be negative. And then here's a longer view of that same chart. And then this is a newer chart that I've been bringing up where we're seeing the 50 period, 150 and 200 period moving averages, we're seeing a sustained decline. So if things were to actually switch back and go positive, we would want to see these blue lines breached to the upside, but it's not happening yet. Looking at the broad market, here's the S&P, where now we're down at the lower end of this mess that we've been battling with, where the mid caps, they're more in about the middle to lower part, and small caps. And I have an interesting chart that I'm going to bring up at the very end to do a relative study where small caps have actually been holding up a little bit better, which might sound surprising. And I'll talk about that here in just a moment. The FANG stocks had a down day. They were down almost 4.25% and have been showing a lot of weakness. ARC also had a bad day, down 6.65%. Industrials still down more towards the bottom end of this range, still have some support underneath where we're at. And that low from a few weeks ago, we still haven't taken that out yet, but we're seeing the cross with the Dow. Small caps, this is looking a little more positive. It's frustrating because it's not going anywhere, but these have been holding up a little bit better, even though they are negative. Mid caps, kind of the same thing, holding up fairly well, but still negative overall. NASDAQ looking a little more weak, but we're still above support, but we're dealing with a recent cross. NASDAQ 100, kind of the same thing, recent cross below the pivot, but still above some support that we had hit before. Then looking at the Vixen, which is the VIX of the NASDAQ 100, it actually showed a decline, or excuse me, an advance with the downturn on Friday. And we're seeing more of the higher highs and higher lows with fear, but it started off pretty good. It just didn't end very well on Friday. NYSE, broad-based measurement. We're still kind of in this sideways action. S&P 100 did underperform the S&P 500 on Friday. And then the Wilshire, another broad-based indicator or index, we're still kind of within this mess that we have yet to try to get out of. Internationally, China's really having a lot of trouble. And then the other international indexes are also showing declines. Our alt stocks had a little bit of a bounce on Thursday, but then came back down over 1.33% on Friday, and we're dealing with a recent cross. Broad market areas, the dollar, which got just hammered on Thursday, came roaring back on Friday. And it was only up 0.64 for the day, but it's getting up to that 99 level. So it's really been doing quite well, especially with all these boycotts and sanctions and things, which is just hammering the Russian ruble. Well, that's helping to make the dollar go stronger, and it's also weakening the euro. And then here's our weekly chart, which shows that we are in a pretty solid uptrend as far as the dollar index is concerned. Then looking at oil, where we're going parabolic up, we got up to the 130 level. Now we're back down around 109, which is still very, very high, but much higher than, or much lower than it had been. Here's gold, which looked like it could be doing some kind of a breakout. It ended up dropping below 2000 on Thursday. Well, it dropped even further on Friday. So we're just watching that to see. And then here's the gold ETF. Here's the, you can make some kind of island reversal type of thing if you're a candlestick person. But we really saw a huge breakout only to have that come right back down on Friday. And then this is just a longer term chart of the gold ETF that we're looking at, where we're off the highs and we still have yet to break the high set during the COVID era. And then silver, which also has been looking pretty good, but it still declined 0.58% on Friday. But you're seeing this is a little healthier look. We broke through the 200-day moving average. We're seeing things start to turn back up, but we're seeing a series of higher highs and higher lows overall. Then here's just a longer term look at this chart where we have some overhead resistance in the 26 to 27 area for silver. And palladium, which went back and tested the high that was set a while ago. Well, we've come back down since then. Is that a double top, or is that going to turn and go back higher? Bitcoin, which has been kind of floundering back and forth, it spent a lot of the week in the 40s. Now it's dropped below and is in the high 30s. As you talk about these executive orders and different things that they're going to try to place on the Bitcoin market, but are they going to do it now? Are they going to do it in the future? It's kind of leaving things pretty uncertain currently. Looking at bonds, we're still watching this very closely as we're heading lower and lower with our credit spread, our the yield curve. That's what I never seem to get that right. Between the 10-year and the 2-year, if we're coming down here, that potentially could suggest a recession. And then we've broken above this red line, which had been acting as resistance, and we're well above 2% now with the 10-year yield. Here's the international, I'm sorry, these are the US yields. Saw a little bit of a decline in the 30, but a rise in the 10, 5, and 2, with a rise in the 3-month as well. Then internationally, we saw a real increase in interest rates, and Germany was actually able to finish positive for the week, and after spending a long time being at a negative yield. But bond prices overall were down about a third of a percent based on price. Corporate bonds took a hit and have been taking a hit, with the current yield now rising to 3.5%. And then here is the longer term chart of the yield. Then junk bonds, again, in a healthier environment, we will see junk bonds advance. When junk bonds start to break down, that could be negative for the markets as well, meaning the S&P. And then this is what I show periodically about intermarket analysis. This red line is oil, how we just went skyrocketing up, fell back, and then advanced a bit. And then we're seeing the decline in the S&P. We're seeing how gold has been going up, but then falling back. This green line is the dollar, which has been holding up quite well. And then these are the price, or this blue line is the price for bonds based on price, not based on yield. And we're focusing more on the 20-year bond for this measurement. Looking at some relative studies, gold against the S&P, it's still breaking out, but has now fallen back. Then looking at energy versus the S&P, it is still continuing to show a pretty strong breakout move. And then the growth versus the bonds, where growth has been declining overall when you compare it with bonds. And then tech versus the S&P has really been underperforming, and we're below the red line. And then tech versus the 10-year yield. So we're comparing tech with interest rates, where tech has been underperforming. And then this is just a reverse of that. It shows interest rates have been rising as tech has been declining. Then to compare the discretionary with the staples, we saw a little bit of a fall with the discretionary. They had been trying to come back a bit. Those are the things that you don't have to have necessarily. And in a good environment, a good healthy economy, you'll see discretionary go up and staples go down. Well, when we get more defensive, then we buy more staples, things that we do have to have, and we let those discretionary things go for the future. Well, we're seeing a little bit of a decline after Friday in discretionary. And then comparing the S&P with the 10-year yield. This is just comparing how the S&P has done compared to rising interest rates, and it has really underperformed. Let's see, did I miss one? Let's see, where I hit a button and it went crazy. Okay, this is the kind of the new chart that I want to talk about, and I'm going to be doing some more analysis and study on this, but this could potentially be positive. If you look back in history, if you see when we hit market bottoms, a lot of times this red line, these are small caps, and sometimes they have a tendency to turn up before the broader market or the S&P 500 does. If you look back in 2009, we started to see small caps improve as we were coming back up out of that big canyon or chasm that we came out of back in 2009. And we were starting to set higher lows as we were coming out of that, while the S&P was still recuperating. Well, look at what's happening now. We're seeing the S&P decline, that's the blue line, but we've been seeing some relative strength in small caps. During the COVID plunge, we saw small caps start to recuperate a little bit before the bigger stocks did. So that is another potential backdrop for some kind of a bounce to possibly come out. And I'll have some more charts and studies to show you as I dive a little deeper into this and try to figure out what's going on. So what are we looking for on Monday? We're still in correction territory. We're still, and I've changed that to an intermediate term range. An intermediate term to me is weeks to months. And we've been in that range for a long time. We're coming up, end of March will be when earnings season actually ends. And then there's still this battle between growth and value. On Monday, there are no economic reports coming out. And the other geopolitical events, apparently the Iranian talks have stopped. I haven't really heard much about us talking with Venezuela concerning oil. But the big news, of course, is what's going on between Russia and Ukraine. So what is our conclusion? The S&P is negative and at the bottom of the range. Short and intermediate term continue to be negative. Long term, we are turning negative the longer we stay underneath those moving averages. But is there some kind of a base forming? I'm not predicting anything here. I'm just seeing a lot of things coming together that sometimes suggest that we could be at a bottom. Now, we might get a bit of a bounce out of that, and those sentiment and emotional things go away, and then we begin to go back down. Or we might get some kind of a bounce out of this, go back up, things are looking a lot better, and that ends up being the ultimate top before we get ready to really go lower into the future. Those are just some of the different scenarios that I'm playing with right now. So thank you very much. I hope you have a wonderful weekend. I will be preparing a weekly video that I hope you also will find helpful. So have a great weekend and hopefully a good start to your week. And I'll talk to you after Monday's action.